Hello everyone, welcome back to Eco Talks with Sneha Manerikar. In today's session, we'll discuss the remaining questions from ISLM curve and the new concepts from government budget. Let us start with the first question. An increase in aggregate price level P will most likely have which of the following effects? A. Rightward shift in IS curve. B. A leftward shift in IS curve. C. An upward shift in LM curve. D. A downward shift in LM curve. Answer is A. An upward shift in LM curve because of increase in aggregate price level. Next question. Which of the following will occur if there is an increase in taxes? A. IS curve shifts and the economy is moved along the LM curve. B. The LM curve shifts and economy move along the IS curve. C. Output will change causing a change in money demand and shift of LM curve. D. Neither IS nor LM curve shifts. E. Both IS and LM curve shifts. Answer is A. IS curve shifts and economy will move along the LM curve when there is increase in taxes. Next question is, suppose the current level of output and interest rate are such that economy is operating on neither the IS nor the LM curve. Which of the following is true for this economy? A. Production does not equal demand. B. Quantity supplied of bond does not equal to quantity demanded of bonds. C. The money supply does not equal money demand. D. Financial markets are not equilibrium. E. All of the above. Answer is E. All of the above, because nor the goods market is in equilibrium nor the money market is in equilibrium. So production will not be equal to demand, nor the bond supply and bond demand will be equal. Even money supply will not be equal to money demanded, and financial market, that is money market, will not be in equilibrium. Next question. Suppose the economy is currently operating on both LM and IS curve. Which of the following is true for this economy? A. Financial markets are in equilibrium. B. Quantity supplied of bonds equals the quantity demands of bond. C. Production equals demand. D. The money supply equals money demand. E. All of the above. Answer is E. All of the above, because as economy is operating on both IS and LM curve, that is economy is equilibrium in both goods market as well as money market. So all these 4 points are true for the economy. Next question is, the IS curve will not shift when which of the following occurs? A. Reduction in government spending. B. Reduction in consumer confidence. C. Reduction in interest rate. D. All of the above. E. None of the above. Answer is C. A reduction in interest rate will not shift the IS curve because it will be movement along the IS curve. Next question. Based on our understanding of ISLM model that takes into account dynamics, we know that reduction in money supply will cause A. Gradual increase in R, that is interest rate, and gradual reduction in income, that is Y. B. An immediate increase in R and no initial change in Y. C. An immediate drop in Y and immediate increase in R. D. None of the above. Answer is B. An immediate increase in R, that is interest rate, and no change in the initial income. Next, which of the following best defines the LM curve? A. Illustrates the effect of change in R on desired money holdings by individual. B. Illustrates the effect of change in R on investment. C. Combination of R and Y that maintain equilibrium in goods market. D. The combination of R and Y that maintains equilibrium in financial market. Answer is D. The combination of R and Y, that is interest rate and income, that maintain equilibrium in financial market, that is money market. He defines the LM curve. Next question. A reduction in consumer confidence will likely have which of the following effects? A. Rightward shift in IS curve. B. Leftward shift in IS curve. C. An upward shift in LM curve. D. Downward shift in LM curve. Answer is B. Leftward shift in IS curve when the reduction in the consumer confidence. Next question. Assuming that investment spending depends only on output and no longer depends on the interest rate. Given this information, an increase in money supply will cause investment to increase. B. will cause an increase in output and have no effect on interest rate. C will cause a reduction in the interest rate. D will cause investment to decrease. E will have no effect on output or the interest rate. Answer is C. It will cause reduction in the interest rate. Next, which of the following statement is consistent with given IS curve? A. An increase in government spending causes an increase in demand for goods. B. Reduction in interest rate causes investment spending to increase. C. Reduction in interest rate causes money demand to decrease. D. Reduction in interest rate causes an increase in money supply. E. An increase in tax causes reduction in demand for goods. Answer is A. Answer is B. A reduction in the interest rate causes investment spending to increase when the given IS curve. Next, which of the following best defines the IS curve? A. Combination of interest rate and income that maintains equilibrium in goods market. B. Illustrates the effect of change in interest rate on investment. C. Combination of interest rate and income that maintain equilibrium in financial markets. D. Illustrates effect of change in interest rate on desired money holdings by individual. Answer is A. The combination of interest rate and income that maintain equilibrium in the good market is best definition for IS curve. Next question. Which of the following is the definition for real supply of money? A. The stock of money measured in terms of goods, not dollars. B. Stock of high-powered money only. C. Actual quantity of money rather than the official reported quantity. D. The ratio of real GDP to nominal money supply. E. The real value of currency in circulation only. The answer is A. The stock of money measured in terms of goods and not the dollars is the definition for real supply of money. Next question. Which of the following is true for given point on LM curve? A. The goods market is in equilibrium. B. Production is equal to demand. C. No inventory investment equals 0. D. All of the above. E. None of the above. Answer is E. None of the above. Because LM curve is about the money market and not about the goods market. Next question. Based on our understanding of ISLM model that takes into account dynamics, we know that reduction in government spending will cause A. Gradual reduction in R and immediate reduction in Y. B. An immediate reduction in R and no initial change in Y. C. An immediate drop in Y and immediate increase in R. D. Gradual reduction in R and gradual reduction in Y. Answer is D. When there is reduction in government spending, it will cause gradual reduction in R as well as gradual reduction in Y. Next question. Assume that investment does not depend on interest rate. A reduction in money supply will cause which of the following for this economy? A. Increase in investment. B. No change in the interest rate. C. No change in output. D. Reduction in investment. Answer is C. There will be no change in output when investment does not depend upon the interest rate. Now let us see the concepts from government budget. First question is, an annual statement of revenue and expenditure by government is known as A. Revenue budget. B. Budget. C. Capital budget. D. None of this. Answer is B. Budget. It is defined as annual statement of revenue and expenditure by government. Next, those inflow of money to the government account against which no liability of repayment is created is called A. Revenue receipt. B. Capital receipt. C. Revenue expenditure. D. Capital expenditure. Answer is A. Revenue receipts. These are the inflow of money to the government accounts against which no liability will be created. Next, those inflow of money to the government against which liability of repayment devolves upon the government is known as A. Revenue receipts. B. Capital receipts. C. Revenue expenditure. D. Capital expenditure. Answer is B. Capital receipts. These are the inflow of money to the government account against which liability is developed. Next, a statement relating to revenue expenditure and revenue receipts of the government is known as A. Revenue budget. B. Budget. C. Capital budget. D. None of these. Answer is A. Revenue budget. It is a statement relating to revenue expenditure and revenue receipt of the government. Next, a statement relating to capital receipts and capital expenditure of government is known as A. Revenue budget, B. Budget, C. Capital budget, D. None of this. Answer is capital budget. It is statement relating to capital receipts and capital expenditure of the government. Next, a budget in which the receipts of the government exceeds its expenditure is called A. Surplus budget, B. Deficit budget, C. Balanced budget, D. None of the above. Answer is surplus budget. Receipts are more than expenditure, then it is called as surplus budget. Next, a budget in which receipts of government fall short to its expenditure is known as A. Surplus, B. Deficit budget, C. Balanced budget, D. None of the above. Answer is B. Deficit budget. When receipts are less than expenditure, it is known as deficit budget. Next question. A budget in which receipts of the government are matched by expenditure is known as A. Surplus budget, B. Deficit budget, C. Balanced budget, D. None of the above. Answer is C. Balanced budget. Here receipts are equal to the expenditure. Next, when revenue expenditure of government is greater than revenue receipt, it is called as budget deficit, revenue deficit, fiscal deficit, or monetized deficit. Answer is B. Revenue deficit. That is, revenue expenditure is greater than revenue receipts. Next question. When overall expenditure of government is greater than overall receipt, it is called A. Budget deficit, B. Revenue deficit, C. Fiscal deficit, D. Monetized deficit. Answer is A. Budget deficit. That is, overall expenditure is greater than overall receipts. Next, the excess of overall expenditure over the sum of revenue receipt and recoveries of loan is called as A. Budget deficit, B. Revenue deficit, C. Fiscal deficit, D. Monetized deficit. Answer is B. Revenue deficit. It is excess of overall expenditure over sum of revenue receipt and recoveries of loan. And next question is, when interest payment is deducted from fiscal deficit, it is called A. Budget deficit, B. Revenue deficit, C. Fiscal deficit, D. Primary deficit. Answer is D. Primary deficit. That is, interest payment deducted from fiscal deficit will give us the primary deficit. That's all about today's session. I hope you understood all the concepts clearly. If you have any doubt, you can ask me in comment section or message me on Telegram group EcoTalks. Don't forget to like, share and subscribe. Thank you.